Buying back the rally. Hi, Dean Jenkins with FollowMeTrades.com, and this is the market update for the week coming up of December 9th, 2019. So I'm showing the chart of the S&P 500, and of course, the S&P 500 and all the other indexes had a strong rally on Friday based on a really strong jobs report. The S&P 500 was up, it closed up nearly 1%. Let's look at the Dow. The Dow rallied over 300 points, 337 points. The charts really look the same. We had last week, early this week, previous week, pretty sharp decline, and then a climb back, and then on Friday a pretty strong rally again on that jobs report. And here's the big question. We got this prior all-time high up here, so with a little bit of a sharp pullback, we got either an ongoing bull market with just a series of higher highs, higher lows, higher highs, higher lows, and maybe on to higher highs, or if it reverses below this period, this level, this price level, and takes out this low here, and I'll draw this line on the Dow, about 27,265. If it goes below that, then we got a correction forming. That's pretty clear from a technical basis. And the chart looks exactly the same on the S&P 500. We've got the all-time high up here. We've got this low down here. So we're watching carefully. If it breaks through, then we just got an ongoing uptrend. And if it breaks through this low, then we've got the beginning of a correction. I thought it was interesting. I saw this article on the Wall Street Journal over the weekend. And the article said, investors bail on stock market rally, fleeing funds at a record pace. And you can see the bar chart here. This is the money that's been pulled out of, index-based and ETF index funds. And the amount of money coming out of the market is increasing pretty dramatically. And this is from both individual investors and institutional players. And so, with all that money coming out of index funds, index ETFs, why is the index continuing? Well, it's led by a handful of companies, and that article goes on to explain it. It's a pretty good article. If you have access to the Wall Street Journal, you'll want to read it. But their thesis is that this market is being driven by a handful of companies who are doing pretty substantial stock buyback. So the companies are driving their own stock price up through buybacks and driving their stock price up, and there's just a handful of companies driving this overall index rally. It's pretty interesting theory, but that individual investors, even institutional investors, are pulling money out, kind of booking their profits after this incredible bull run, and going to money market funds and bonds, and also to gold. And let's take a look at gold. Gold looks like it is setting up potentially for a rally. So it had this big run up, had this nice correction. It's a perfect Elliott wave formation, and now gold is starting to show signs of a rally. Now it's too early to go into gold. And, you can trade futures, you can trade gold mining stocks, or you can trade the gold ETF, GLD. GLD is going to look exactly like this future chart. Different scale, but the same exact pattern. And so if we see gold break above the 50-day moving average, on the GLD, it's around 139.80. We can just call that 140. If it puts in, we got a high, higher, low, high, higher, low. If it goes up above the 50-day moving average, this line up around, let's call it 140, then we probably got a rally starting in gold, and that's not a bad place to take a defensive position in. So it's all going to be driven, though, as we watch how the indexes play out this coming week. Again, do they put in a new high, or do they reverse and put in a low? So we're at a kind of a critical decision point. In terms of news that could affect this, what do we got coming up this week? Well, of course, the China trade deal is still, probably the biggest deal. The president has signaled that we may not get something done until after the after Christmas, after the new year. So expectations are being set there. We get kind of new information every day. We do have the FOMC meeting this coming week and the announcement on Wednesday, December 11th. And of course, the FOMC meets and talks about interest rates. Now, the 100% expectation is that the Fed will do absolutely nothing, that they're happy with where rates are at. They're not going to cut. They're not going to, increase interest rates. So as long as they do what's expected, probably not a non-event. If they do something unexpected, cut rates or increase rates, stand by. There could be a pretty big market reaction. So, the summary, we're in this kind of key decision point. Will we put in a new low, a high? Will we come down and break out this low, start a correction? We just got to watch and wait and be ready. It is interesting that people are pulling money out of the market, booking their profits, and moving to safe havens. There are still significant indicators about global slowing. The U.S. had a pretty good jobs report on Friday, drove a rally, but there are some indicators. It's funny how quickly the financial media has shifted from talking about, recession is coming, it's imminent, or, highly probable, to, everything's great. Increasing jobs, increasing wages, all kinds of good positive stuff. But that could turn pretty quick. So we're just going to have to trade the realities of what's going on here in the market, pay attention, and participate in whatever the market's doing. Try to put our expectations of what it should do on the back shelf, trade the realities. And of course, that's what we're doing at Follow Me Trades. And we've got some short positions that are doing well. We got some long positions that are doing well. And we're just, again, paying attention to what's really going on, being cautious, and trying to capitalize and profit from that reality. So that's it for this week. We, again, at a key decision point, we got to watch. And if anything exceptional happens, we'll send a midweek update. Other than that, it'll come out next weekend. All right, take care, trade safe, and we'll see you on the next one.